I am Gabriel Penagos, Professor of Finance in the Department of Economics at Pontificia Universidad Javeriana, Bogotá, Colombia, and this is the module of Financial Markets. Liquidity risk is the risk of a large unexpected demand for funds. Since depositors can withdraw or transfer their savings anytime, or clients can claim funds from their lines of credit, if the bank cannot fulfill customers' requests for funds, it can fail. To prevent this situation, regulators require a reserve as a percentage of deposits to cope with unforeseen liquidity demands. The amount of money above the reserve is called the excess reserve, and it constitutes a passive way to manage liquidity risk. The drawback to this approach is the loss of interest we might otherwise have had if we were to invest this money in securities. The bank can sell securities or liabilities from its portfolio, especially those that are highly liquid, to cope with liquidity requirements. Although these mechanisms are effective, banks benefit from having a large number of assets because they turn liabilities into assets by maturity transformations. Therefore, a better approach to selling assets is to obtain additional funds, either borrowing from the central bank or another bank, or attracting new deposits to cover the shortfall, for example, by issuing illiquid assets like CDs. Interest rate risk arises when the investment horizon is shorter than the maturity of the liabilities, which leads to uncertainty in the holding period return. A position in a long-term bond can be closed before maturity. However, the selling price is unknown, causing risk in the investment return. As we saw previously, intermediation is carried out by maturity transformation. Banks collect short-term deposits and convert them into long-term loans. The time difference between assets and liabilities generates interest rate risk. If we think of assets and liabilities as bonds, a change in interest rate hits long-term bonds heavily. Hence, the price drop because of increasing interest rates is larger for a longer maturity. This causes the value of its assets to fall faster than the value of its liabilities. Long-term bonds pay the same coupon during their life and do not depend on changing market interest rates. However, short-term bonds mature frequently and are replaced by new ones that reflect prevailing interest rates in the market. Therefore, we can consider them to be interest rate sensitive, while long-term bonds are not interest rate sensitive. Interest rate risk arises from the mismatch between long-term loans or assets not bearing with interest and variable interest short-term liabilities. Banks conduct a gap analysis calculating the yield difference between interest-sensitive assets and liabilities to assess the profit sensitivity in changes in interest rates. To deal with interest rate risk, banks can buy short-term assets or long-term floating interest rate assets. The latter carries a risk of default as interest rates rise. Other options include the use of swaps or other derivatives. Trading aims to make profits for the bank by buying and selling securities in the market. If the expectation is that prices will go up, then investors buy securities and sell them later to make a profit. If, on the contrary, the expectation is that prices will go down, investors should short sell securities at high prices to buy them at low prices and make a profit. To short sell a security, the investor borrows a security from another portfolio, sells the security, repurchases the security when prices are down, and returns the security to its original owner. It's a risky activity as the prices of securities changes, which is known as market risk. Credit risk arises from the possibility that the bond issuer might fail to make the promised payment. Among risks faced by bondholders, this is one of the most significant. As we saw before, there is a need for information in order to deal with this risk. To reduce information costs, some companies have specialized in calculating the chance that a bond issuer, a firm, or a government will default. Well-known rating agencies such as Moody's, Standard & Poor's, and Fitch calculate the likelihood of default for a wide range of debt issuers and debt instruments. Creditworthiness is assessed based on financial information, and the ratings are published as credit rating codes, which are combinations of letters. Rating agencies use AAA, for example, for the best grade down to D for default. Sometimes they may use a plus or minus sign or a number like AA plus or AA1 to give a finer classification. However, exact probabilities are not supplied. Instead, a broad description is given to each grade. High ratings suggest that the issuer is in a good position to meet its obligations. The ratings are further grouped into investment-grade bonds with a relatively low risk of default, non-investment grade bonds, speculative investment securities, high-yield bonds, or junk bonds are investment of low credit quality. Speculative bonds are either bonds from a low-quality issuer or fallen angels, bonds that were once investment grade but have now been downgraded. Agencies also notify investors of the likelihood that a given rating will be upgraded, downgraded, or remain unchanged. Regulation requires that banks hold investment-grade bonds. As investors require compensation in order to bear risk, the higher the risk of default, the higher the interest rate required and the lower the price. It is useful to compare the returns on risky investments to riskless ones. Treasury bonds are used as benchmark because they are perceived to have a low default risk. The difference between a bond rate and a treasury rate is the risk spread or default risk premium. A bond yield is the sum of the treasury's yield and the risk spread. The higher the credit rating, the lower the default risk spread. Also, when treasuries move, the interest rates of the bonds move. Ratings are especially important for borrowers because an increase in interest rates causes a deterioration in credit rating, increasing its cost for financing.